Everybody knows SoFi for the stadium or the app, but most people don't realize they are actually powering the whole fintech sector, which is why they have been labeled as the AWS of fintech. They are essentially powering their competitors like Robinhood. There is also a lot of talk of a potential S&P 500 inclusion around the corner, which would mean a complete re-rating of the company. So in this video, I'll be breaking down what SoFi does and if this banking company truly justifies its recent growth. So this is the Brummy Investor channel where I break down companies to see if they are a viable long-term investment. If you don't want to miss on any future videos, drop us a follow. And with all that being said, let's get into the video. So having a background look into the company, SoFi, stock ticker SOFI. They are an all-in-one platform which allows users to borrow, save, spend and invest all in one app. So the current market cap is about $23.69 billion. The sector is within the financial services, specifically being a fintech company which uses software or AI to improve upon traditional banking. Similar companies are like Chime, Robinhood, PayPal and Affirm. The headquarters are located in San Francisco and California, and the current employee count is about 6,100 employees. They were founded in 2011 by the CEO Anthony Noto. So what does SoFi actually do? So SoFi has three distinct segments, the first being their lending. This is through personal, home and student loans. Originally they began as a student loan company for more affordable lending options, but since then they have scaled drastically. So now lending only represents less than 50% of the total revenue. The next core pillar is their financial services, which is their growth engine. This includes SoFi Money, SoFi Invest and their credit cards. So what makes SoFi unique is their financial services productivity loop. This is basically a self-reinforcing business model which gives them an advantage as their platform is so wide. Once they have customers on their platform, they can be funneled into various different parts of the business. So put simply, they're reducing the customer acquisition costs whilst increasing retention. And finally, we have the technology platform, which is why they are labeled as the AWS of fintech. This is because of Galileo. So Galileo acts as the infrastructure powering major fintech companies like Robinhood and Dave. It helps with real-time payment processing, card issuing, and fraud detection. So even if you don't use SoFi, you might be using a card powered by SoFi's technology. This shows the dominance within the fintech space. So looking into some potential catalysts for the company. The first being the SoFiUSD stablecoin. So a recent partnership with Mastercard has allowed them to use the stablecoin for settlement on Mastercard's global payment network, and this is the first time such a thing is happening on such a big scale. So put simply, they will be able to settle or move more money around 24/7, and it will help for faster international transfers. So we can be more flexible by using these digital assets. And linking this to Galileo, it will be one of the first to offer to other fintechs the ability to settle their own card transactions using SoFi USD. Another catalyst would be the potential S&P 500 inclusion. They now meet the key criteria of having positive earnings and significant revenue growth. They also have strong history of being GAAP profitable with 9 plus quarters of positive net income. There was also a recent insider CEO buy of $1 million worth of share, so this could also be a huge sign. The inclusion is rumored to be in late 2026 or into early 2027, and the inclusion would mean a re-rating as millions of shares would be bought, so there would be a nice juicy pump. So taking a look into the financials behind the company. So these reports are from the latest Q4 earnings report 2025. So adjusted net revenue came in at $1.01 billion for Q4, which represents a 37% increase year over year, and for full year 2025 it was $3.59 billion. So for GAAP EPS, which is simply the earnings derived from the business as a whole, it came in at 13 cents, which is a massive 160% increase year over year. And for financial year 2025, it was $0.39. And finally, GAAP net income came in at $173.5 million, which represents the first time that there was a $100+ million quarter. And overall for financial year 2025, it was $481.3 million. So in Q4 of 2025, SoFi reported a Rule of 40 score of 68%. This is an incredibly high score as anything over 40 is considered to be elite. So the Rule of 40 is a universal metric which identifies the health of a company, normally for SaaS companies, which stands for software as a service. It is when the combined value of the revenue growth and EBITDA margin are above 40. So this indicates strong health for SoFi. In Q4, they also reported the first ever 1 billion revenue quarter, and 57% of this came from non-lending income, which means they are slowly diversifying, making them less vulnerable to interest swings. For future guidance, they are aiming for a 30% compounded annual revenue growth rate going into 2028, and they aim to grow EPS by nearly 40% a year. So taking all these factors into account, is it a buy? So the bull case is that SoFi has been labeled as the bank of the future as it integrates crypto, stablecoins, and traditional banking all into one unified app. And following on from this, the unique technology platform which is used across many different banking companies, which is why they are known as the AWS of fintech. And finally, the fundamentals behind the company are growing at incredible rates, like being gap profitable for the last 9 straight quarters. And all this points to a potential S&P inclusion soon. However, on the other hand, we have the bear case, and the first and most important is their direct exposure to interest rates. Trump has chosen Kevin Warsh as a new Fed chair, so this all depends on the US economy and if rates will be cut. Another potential negative is that SoFi is valued more like a tech stock rather than a traditional bank, so a multiple compression can disrupt the value, which is why the S&P inclusion is important. And finally, they have a lot of competitors as the banking sector isn't small, so they need to ensure they continue to grow their product or others will begin to catch up. So is it a buy? The average price target of SoFi is around $27 to $28, which is a 50% increase from current levels, with the best case pushing the $40 range. Again, this is all dependent on the S&P inclusion. So for me personally, I do own a small position as I like the company and I feel there's a lot of unnecessary sentiment around it. So I'm planning to hold for some time, probably until the inclusion. But this is not financial advice, so always do your own research and let me know in the comments below if you do own SoFi. So thank you for watching the video. Remember to like, subscribe and leave a comment below. If you like this company breakdowns, let me know what company I should do next.